Imagine this. A direct deposit from the IRS, um, potentially putting thousands of dollars right back into your pocket. Or even better, maybe saving you from a really unexpected, hefty tax bill that could just blindside your budget, especially when it comes to healthcare costs.
Yeah, that sounds like a financial superpower, right? Who wouldn't want that?
Exactly. Keep more of your hard-earned money. Avoid those, dreaded financial surprises.
It's absolutely a superpower for many, and it's very real. But here's the thing, the stark reality is a surprising number of people either completely miss out on this incredible opportunity.
Really? They just miss it.
Yeah, or sometimes worse, they end up owing money back because they don't fully grasp the crucial details of how this whole system works.
Yeah.
It's kind of like having a valuable coupon, but, not reading the fine print until you're standing at the checkout.
Ouch. Okay, so that's where we come in today. We are diving deep into exactly how you can unlock and really maximize this financial benefit. Our mission in this deep dive is to illuminate the premium tax credit, or PTC. It's a really powerful mechanism specifically designed to make quality health insurance genuinely affordable for folks.
Mm-hmm.
We're going to unpack IRS Form 8962. That's the official key, basically, to calculating and reconciling this credit.
It's a crucial form.
Exactly. And our goal here is to transform what feels like, a confusing, complex tax form into a clear roadmap. We want to reveal exactly how understanding its intricacies can save you significant money and, frankly, a whole lot of headaches.
Yeah, avoid those headaches.
We'll explore the core requirements, we'll demystify the calculations, and maybe most importantly, highlight the specific scenarios and crucial proactive steps that can make a real difference in your tax outcome. Turn that confusion into clarity and potential savings into actual dollars you can count on.
Sounds like a plan. Let's do it.
All right, let's unpack this. First big question.
Yeah.
What exactly is the premium tax credit, and how do these advance payments play into it? This is really the foundation we need before we get into the strategies.
Okay, so at its heart, the premium tax credit, the PTC, it's a refundable tax credit. Now, refundable, that's the really key word here.
Why is it so important? Refundable.
Because it means it can do more than just, reduce your tax bill down to zero. It can actually put money back into your pocket as a refund, or maybe increase a refund you were already expecting.
Okay, so it's actual cash back, potentially.
Potentially, yes. It's financial assistance, specifically designed to help individuals and families cover the cost of health plans they bought through a health insurance marketplace. Like healthcare.gov, or maybe your state has its own specific exchange.
Gotcha.
And this is vital. To compute and claim this credit, you must file Form 8962 with your tax return. There's just no getting around it if you want this benefit.
Okay, mandatory form. So it's a direct financial boost for health insurance. But then we hear about these advance payments, APTC. Is that where things get a bit tricky?
That's precisely where the rubber meets the road, as they say. Advance payments to the premium tax credit, APTC, they're just what they sound like. Payments made in advance directly to your insurance provider throughout the year.
Oh, okay. So not to me, but to the insurance company.
Correct. The marketplace, they estimate how much PTC they think you'll be eligible for. That's based on the income and family size you project for the upcoming year. And then they send these payments to your insurer to cover part or maybe even all of your monthly premiums.
Ah, so it makes the monthly bill lower right away.
Exactly. It's designed to help with affordability immediately, so you don't have to wait until tax time, months later, to get the full benefit.
That sounds incredibly helpful up front. But you mentioned reconciliation earlier, and that sounds like where those unexpected bills might sneak in. Can you explain that sort of moment of truth?
You're hitting on the absolute most critical aspect for your wallet here. That reconciliation on Form 8962. Think of it like your annual financial checkup for this credit. You compare the APTC, the advance payments that were sent on your behalf throughout the year, with the actual premium tax credit you were truly entitled to. And that's based on your actual final income and family circumstances for the year.
So estimate versus reality.
Precisely.
Huh.
Now, if the APTC paid was less than your actual PTC, fantastic. You get the difference back. It comes as an additional credit on your return, or maybe just a bigger refund. That's a direct financial win for you.
Nice.
But, and this is where, careful planning and being proactive in reporting changes becomes your absolute best friend. If the APTC paid was more than your actual PTC, well, you have to repay that excess amount.
Ah, okay. That's the unwelcome surprise.
That's the unwelcome surprise.
Yeah.
This discrepancy, it often happens because, life changes, right? Income changes, family size changes, and maybe those weren't reported promptly to the marketplace. That difference is the #1 reason people get those unwelcome, unexpected tax bills.
What?
So understanding this reconciliation process isn't just about, filling out a form correctly. It's your first and most important step in protecting your finances and keeping that hard-earned money. It's really a proactive tax-saving strategy in action.
That makes so much sense. It really highlights why paying attention throughout the year matters so much here. Okay, so who actually gets to qualify for this premium tax credit? What are the baseline eligibility requirements we need to know?
Right. So to qualify for the PTC for, say, 2024, the IRS lays out several fundamental conditions you need to meet. Okay, first, for at least 1 month of the year, someone in what the IRS calls your tax family must have been enrolled in a qualified health plan through a marketplace.
Okay, marketplace plan.
And crucially, they need to have been enrolled on the first day of that month. That first day is key.
Got it. First day.
Second, generally speaking, that same individual couldn't have been eligible for other minimum essential coverage, or MEC, for that month. Now, MEC usually means things like most employer-sponsored health plans or government programs like Medicare or Medicaid.
So if you could get insurance through work, you probably can't get this credit.
Usually, yes. The exception is individual market coverage you bought outside the marketplace that doesn't disqualify you. But yeah, employer coverage, government coverage generally makes you ineligible for the PTC, for that person for that month.
Okay.
Third, your share of the monthly premiums for the policy, whatever wasn't covered by APTC, must have been paid by your tax return due date. There's a little wiggle room, a special rule for appeals, but generally you got to pay your share.
Makes sense.
Fourth, you can't be claimed as a dependent on someone else's tax return. Pretty straightforward.
Okay.
And finally, the big one, you must be what the IRS calls an applicable taxpayer. And this brings us to some specific requirements around your household income and your tax filing status.
Applicable taxpayer.
Okay.
Okay, that sounds like the master key to unlocking this whole thing. What does that phrase really entail? What does it mean?
It absolutely is the master key. For starters, your household income for the year generally needs to be at least 100% of the federal poverty line, or FPL, for your family size. There are some exceptions we'll touch on later, but that's the general floor.
Okay, 100% FPL minimum.
But here's a really crucial point, one that catches so many people off guard. And it often leads to having to repay all of the APTC they received. It's a huge pitfall.
Uh-oh, what is it?
If you were married at the end of the tax year, December 31st, you must generally file a joint tax return with your spouse to be able to take the PTC.
Wow, okay. Married filing separately is usually out.
Usually, yes. It's a pretty non-negotiable rule for most people. Filing separately generally disqualifies you. But, like I said, we will dive into some very specific, important exceptions to this rule later on. Because knowing about those exceptions can be a massive tax-saving lifeline if they happen to apply to your situation.
Good to know there are exceptions. Okay, so it's not just getting covered, but how you're covered, how you file your taxes, it all matters. Before we dive into the nitty-gritty calculations, let's nail down a few key terms. These seem absolutely essential for understanding this credit. What do we mean by tax family?
Right, good idea. Your tax family, for PTC purposes, that's really the foundation of your eligibility. It includes you, your spouse, if you're filing jointly and aren't someone else's dependent, and any dependents you claim on your tax return. That number, your total tax family size, is absolutely critical because it's the starting point. It determines your eligibility, it drives the calculations. It basically sets the stage for everything that follows on Form 8962.
Okay, me, spouse of filing jointly, and dependents I claim. Got it. Now, household income. Is that just my regular salary? Because I think that's what most people think of as their income.
Yeah, that's a common thought, but it's actually a bit more specific for the PTC. For PTC purposes, household income is your modified adjusted gross income or modified AGI from your main tax return. Let's call that your modified AGI.
Modified AGI.
Okay. Plus, and this is important, it also includes the modified AGI of any dependents you claim who actually had enough income that they had to file their own tax return.
Oh, okay. So dependents' income can count too if they have to file.
Right. It's about casting a slightly wider net to get a fuller financial picture for the household. Now, modified AGI itself, it starts with your adjusted gross income, or AGI. That's what most people think of as their core income from their 1040. But then the IRS adds back a few specific types of income that aren't usually taxed.
Like what? What gets added back?
Things like tax-exempt interest, maybe from municipal bonds, any foreign earned income you might have excluded from your regular income, And even the non-taxable portion of your Social Security benefits gets added back in for this calculation.
Wow, okay. So it's a broader definition of income than usual.
Exactly. And getting this modified AGI figure right is absolutely vital because it directly impacts how much credit you're eligible for.
Hmm.
A miscalculation here.
Yeah.
Well, it can either mean you miss out on credit you actually deserve, or, unfortunately, you could end up with one of those unexpected repayment demands. So precision matters.
Definitely sounds like it. So, modified AGI gives a more comprehensive look at your financial resources. That makes sense. Now, is coverage family different from tax family? You mentioned tax family.
Yes, good question. It is a critical distinction. Your coverage family refers specifically to the individuals within your tax family who meet two conditions. They are actually enrolled in a qualified health plan through the marketplace, and they are not eligible for minimum essential coverage, that MEC we talked about, from another source, like an employer.
Okay, so it's a subset of the tax family, only those enrolled and not eligible elsewhere.
Yes, exactly. This distinction is super important because the premium tax credit only applies to the members of your coverage family. So, for example, let's say you have a child who's part of your tax family, but they're eligible for CHIP, the Children's Health Insurance Program. Even if they're also listed on your marketplace plan, you generally cannot claim the PTC for that child for the months they were eligible for CHIP.
Got it. Only for the folks who are both in the tax family A and D eligible for the PTC based on their own coverage situation. Okay. And then there's the applicable SLCSP premium. That one sounds like a real mouthful and potentially quite complicated.
It is a mouthful, yeah.
Yeah.
SLCSP stands for Second Lowest Cost Silver Plan. But understanding this applicable SLCSP premium is absolutely key to how your credit is determined.
Why? What is it exactly?
So this SLCSP premium, it isn't necessarily what you paid for the health plan you chose. You might have picked a bronze plan or a gold plan, right? Instead, the SLCSP is the benchmark premium amount that the marketplace uses. It's the premium for the second lowest cost silver plan available to your coverage family in your specific geographic area.
Okay, so it's a standardized reference point, not necessarily what came out of my bank account for my specific plan.
Exactly. Even if you chose a higher tier gold or platinum plan, your credit calculation uses the cost of that second lowest silver plan available to your family in your area as the starting point.
Why does that specific benchmark matter so much?
Because this is the premium against which your calculated household contribution is measured. We'll get to that contribution amount next. This SLCSP figure is usually reported on Form 1095-A, which we'll discuss in a moment.
Usually reported. Sounds like sometimes it's not.
Well, here's a crucial tip for accuracy and a real potential tax-saving move. This figure can sometimes be incorrect or even missing on that Form 1095-A. This happens especially if no APTC was paid during the year, or if your circumstances changed and weren't reported.
So I might have to look it up myself.
You might. The Marketplace website usually has a tool for this. Knowing how to verify this SLCSP is really important because an incorrect SLCSP amount leads directly to an incorrect credit calculation. That could mean you either miss out on money you're owed or you receive too much APTC and have to get it back. Verifying this is key.
Good tip. Okay, so the SLCSP is the benchmark. How does that relate to my monthly contribution amount? That sounds like what I'm supposed to pay.
Right. Your monthly contribution amount is the portion of your household income that the IRS basically expects you to pay toward your health insurance premiums each month. Think of this as your personal benchmark for what's considered affordable health care for you based on your income.
So it's not what I did pay, but what the calculation says I should contribute.
Exactly. It's calculated by multiplying your household income, that modified AGI figure we discussed, by something called an applicable figure.
An applicable figure, where does that come from?
It comes directly from a specific IRS table, Table 2 in the Form 8962 instructions. And that figure is based on your household income as a percentage of the federal poverty line, that percentage we calculated earlier.
Okay, so the income percentage determines this applicable figure.
Correct. For example, if your household income as a percentage of FPL is, say, 150% or less, that applicable figure is actually 0.000.
Zero. So my contribution is zero.
Your calculated contribution is zero in that case, meaning the PTC would cover the entire cost of the benchmark SLCSP premium. On the other end, if your income is 400% of FPL or more, the applicable figure is 0.0850 or 8.5%.
Huh, okay. So the figure slides based on income.
Right. Understanding this calculation is absolutely key because a lower calculated monthly contribution amount for you directly translates to a higher potential premium tax credit. It's a direct driver of how much benefit you receive.
So these are all the moving pieces of the puzzle that the IRS uses, and the document that summarizes so much of this, the one we're probably all waiting for in the mail each year, is Form 1095-A, right? That's got to be important.
Absolutely indispensable. Form 1095-A, the official name is Health Insurance Marketplace Statement, is truly critical for anyone dealing with the premium tax credit. The marketplace sends this form to you, usually by January 31st each year.
Okay.
And it contains all the crucial information you need to accurately fill out Form 8962. It breaks down your coverage month by month. It shows your enrollment premiums. That's what your chosen plan actually costs in column A. It shows the applicable SLCSP premium, that benchmark price we just discussed, in column B. And it shows any advance payments of the premium tax credit, the APTC, that were paid on your behalf in column C.
Okay, so it's like my scorecard from the marketplace for the year. Columns A, B, and C. What if I receive more than one? Or, what if something on it just looks off? Seems wrong.
Great question. This is a really critical detail for accuracy and, honestly, for avoiding tax headaches down the line. If you receive a Form 1095-A and look at the top if the corrected box is checked.
Corrected, okay.
You must only use the information from that corrected form, the original one they sent. It's now invalid. You should just discard it.
Got it. Use the corrected one only.
Conversely, if you receive a form and the void box is checked at the top,
Void.
that means the original form was sent in error and should be completely ignored. Do not use any information from a voided form for your tax return. Using the wrong form, whether it's an old one or a voided one, is one of the absolute quickest ways to trigger a major calculation error and, potentially get that unexpected tax bill or delay your refund.
Okay, that's super important. Corrected means use it. Void means ignore it.
Exactly. So, as some actionable advice, if you haven't received your Form 1095-A by, say, early February, don't just wait. Contact your marketplace immediately.
Be proactive.
Definitely. And also, if someone else enrolled an individual who is now part of your tax family, maybe a child moved in with you mid-year and became your dependent wall, you'll need to get a copy of their 1095-A from whoever originally enrolled them or from the marketplace to ensure you do the reconciliation accurately. Ignoring this form or using an incorrect version, it's a really common pitfall that can absolutely cost you money or cause significant delays.
Okay, solid advice. Get the right 1095-A. Now we get to the actual mechanics of it all, right? This is where we see how all those definitions and terms come together to actually impact your bottom line. Let's start with part 1 of the form itself, determining your annual and monthly contribution amount. How does that work?
Right. This initial section of Form 8962, Part 1, it's really the foundation for your entire premium tax credit calculation. It precisely determines how much the IRS expects you, based on your household circumstances, to contribute towards your healthcare premiums each month.
And you said earlier, lower contribution means potentially more credit.
Exactly. Remember that. The lower your calculated contribution amount here, the higher your potential credit will be, which can directly put more money back in your pocket, either through a lower tax bill or a bigger refund. This calculation unfolds across those first few lines of Form 8962, lines 1 through 8B.
Okay, walk us through how that picture of our expected contribution gets built step by step. What's the absolute first step?
It all begins with your tax family ties on line 1. You just pull that number directly from your main income tax return, your Form 1040. That's you, your spouse, if you're filing jointly, and any dependents you claim. Simple enough.
Okay, family size first, then what?
Next, lines 2A and 2B. You determine your modified AGI. Line 2A is for you and your spouse, if filing jointly. Line 2B is for any dependents you claim who are actually required to file their own tax return because they had enough income.
Right, that modified AGI again. Remind us quickly what goes into that.
Sure. It's your adjusted gross income, AGI, from your return, plus those specific non-taxable income sources we mentioned earlier, things like tax-exempt interest, excluded foreign earned income, and the non-taxable portion of Social Security benefits. Worksheet 1.1 and 1.2 in the instructions help you figure this out if needed.
So we're building up that comprehensive income picture for the whole tax family unit. What comes next in the calculation after we have the modified AGIs?
Once you have those modified AGI figures on line 2A and 2B, you simply sum them up on line 3 to get your total household income. This is the core income figure the IRS uses for all the PTC eligibility and calculations that follow.
Okay, household income on line 3.
Then, on line 4, you need the federal poverty line, or FPL, amount that applies to your specific tax family size and your state of residence. Remember, Alaska and Hawaii have different FPL amounts than the other 48 states in D.C. And here's a crucial point for timing. For your 2024 tax return, you actually use the 2023 FPL amounts. The IRS always uses the prior year's FPL figures for the current tax year's calculation. You find these in Table 1 in the instructions.
Use the prior year's FPL numbers. Okay, that's a key detail. Got the FTL amount, then comes the percentage, right? That seemed really pivotal for how much you're expected to contribute.
That's absolutely right. Line 5 is where you calculate your household income as a percentage of federal poverty line. This is a really key ratio. You just divide your household income from line 3 by the FPL amount from line 4. Then you multiply that result by 100, and importantly, just drop any numbers after the decimal point. Don't round up, just drop the decimals.
Okay. Divide income by FPL, multiply by 100, drop the decimals. So if it's 149.7%, it's just 149%.
Exactly. That percentage is critical because it directly dictates your applicable figure on line 7. You look up your percentage from line 5 in Table 2 in the instructions, and that gives you a specific decimal figure.
The applicable figure again.
Yeah. This decimal, remember, it ranges from 0 for those well below the FPL up to a maximum of 0.0850 for those at 400% FPL or higher. This figure represents the percentage of your income the government expects you to be able to contribute towards premiums.
Okay, so the percentage drives the applicable figure. Then what?
Then, on line 8A, you multiply your total household income from line 3 by that applicable figure from line 7. That gives you your annual contribution amount.
Ah, the annual amount. And that annual amount then gets us down to the monthly figure, which is probably what most people think about when they consider their health insurance payments each month.
Precisely. The final step in Part On is line 8B. You just take that annual contribution amount from line 8A and divide it by 12 to arrive at your monthly contribution amount. This number, right here on line 8B, is your personal benchmark. It's what the IRS calculation considers an affordable amount for you to pay toward your healthcare premiums each month, based on your income and family size.
And why is that specific monthly number so important again?
Because understanding this number is incredibly important. This calculated contribution amount from line 8B is ultimately subtracted from the second lowest cost silver plan, the SLCSP premium, which we find in Part 2, to determine your actual premium tax credit entitlement. So remember, a lower calculated contribution amount for you on line 8B means a higher potential credit, which can directly translate to more money in your pocket. This entire first part of the form is really about establishing your household's precise share of the affordability equation for healthcare based on the law.
Okay, that makes sense. Part I establishes my contribution benchmark based on my specific situation. Now, Part 2, this is where we actually claim the credit itself and, crucially, reconcile those advance payments, the APTC, that we might have received throughout the year. What's the biggest fork in the road here for taxpayers, the first big choice they have to make?
Right. The biggest decision point you hit right away in Part 2 on line 10, and it's one where a lot of people unfortunately get tripped up, is whether to use the annual calculation on line 11 or the more detailed monthly calculation, which uses lines 12 through 23.
Annual versus monthly. When can you use the simpler annual one?
You can only use the simplified annual calculation on line 11 if, and only if, two conditions are met for the entire year. First, you had marketplace coverage for all 12 months. And second, both your monthly enrollment premiums, what you actually pay for your specific plan, and the applicable SLCSP premiums, that benchmark silver plan cost, were the exact same for every single month of the year. No changes at all.
Wow, the exact same for all 12 months. That sounds pretty rare.
It is quite rare in practice. It's a very strict condition. Any change, even a small one, pushes you to the monthly method.
So if anything changed, even slightly during the year, maybe my premium went up a few bucks or the SLCSP changed because I moved zip codes, then it's definitely the more complex monthly calculation.
You got it. If your coverage was for fewer than 12 months, or if either your enrollment premiums, column A on your 1095A, or the SLCSP premiums, column B on your 1095A, changed at all during the year, even if you had full year coverage, you must check No on line 10 and use the monthly calculation on lines 12 through 23.
Okay, so No on line 10 and use the monthly lines is probably the default for most people.
It is far more common than people realize. Because think about it. Even small life changes. A new baby joins a family, you move across town, you gain or lose eligibility for other coverage for even 1 month. All these things can impact your coverage, family size, or the applicable SLCSP premium amount for certain months. That makes the monthly calculation absolutely necessary.
And making a mistake here could be costly.
Definitely. Many people mistakenly check Yes on line 10 and use the annual calculation when they shouldn't. That leads directly to significant errors in calculating the credit and potentially, you guessed it, an unexpected and potentially large repayment bill when the IRS catches it. Being diligent here, checking no if anything changed, is a key tax-saving tactic, or maybe tax bill avoiding tactic.
Okay, check no and use the monthly calculation as the safer bet for most. So assuming we're doing the more common monthly calculation on lines 12-23, let's talk about those columns A through F. What do they represent for each month we had coverage?
Right. These columns are really the heart of the reconciliation process, where you compare everything month by month. Okay, so for each month, you or someone in your coverage family had marketplace coverage.
Yeah.
Column A is your monthly enrollment premiums. This comes straight from column A of your Form 1095A. It's what your chosen health plan actually cost for that month.
Okay, column A from 1095A goes to column A. Easy enough.
Yep. Then column B is the monthly applicable SLCSP premium. This comes from column B of your Form 1095A, that standardized benchmark silver plan premium for your specific coverage family for that month. Again, make sure this number looks right.
Column B to column B. Got it.
Next, column C is your monthly contribution amount. This is that calculated personal share we figured out back in Part I on line 8B. You'll generally enter the same amount in column C for every month you had coverage, unless certain specific situations apply, like allocating policy amounts.
Okay, line 8B goes into column C.
Then column D is your monthly maximum premium assistance. This is a simple calculation you do right on the form. You take the benchmark SLCSP premium from column B and subtract your calculated contribution amount from column C, so B minus C equals D. This represents the maximum potential credit the government offer you for that specific month based on the benchmark plan cost and your income.
Okay, B minus C is the potential help. Then what's column E?
Column E is your monthly PTC allowed. This is the actual credit you're allowed for that month, and it's the smaller of two amounts. Either what you actually paid in premiums for your plan, which is column A, or are your maximum potential assistance, which is column D. Whichever is less goes into column E. You can't get a credit for more than your plan actually costs.
Ah, okay. The smaller of what I paid A or the potential help D.
That makes sense. That's my actual credit for the month. Exactly. That becomes your actual monthly credit entitlement. And finally, column F is the monthly advance payment of PTC. This comes straight from column C of your Form 1095A. This is what the marketplace actually paid directly to your insurer on your behalf for that month during the year.
Column C to column F. Okay, so we fill that out for every month of coverage. Then, this is where the final reconciliation happens, right? The moment of truth where we see if we got the advance payments right, down on lines 24 through 29.
Precisely. This is where it all comes together. First, on line 24, you sum up all those monthly allowed credit amounts from column E for the whole year. That gives you your total PTC allowed as the actual total premium tax credit you were truly entitled to based on your final end-of-year circumstances.
Okay, line 24 is what I should have gotten.
Right. Then on line 25, you total up all the monthly advance payment amounts from column F. This is your total APTC received. This is what the government actually advanced to you by paying your insurer throughout the year based on those initial estimates.
Line 25 is what I did get in advance.
Exactly. Now you compare the two. On line 26, if your total PTC allowed, line 24, what you should have gotten, is greater than your total APTC received, line 25, what you did get.
That's good news, right?
That's great news. You have net PTC. That difference is a credit that flows directly to your main tax return. It will reduce your overall tax bill or increase your tax refund. That's the ideal outcome, a direct financial boost. You essentially didn't get enough help during the year, so you get it now.
Awesome. But what if it's the other way around? What if line 25 is bigger than line 24 if I receive too much APTC?
Yes. If your total APTC received, line 25, is greater than your total PTC allowed, line 24, it means you were advanced too much money during the year based on your final numbers. In that case, you skip line 26 and move down to part 3 of the form, lines 27 to 29, to figure out your repayment of excess APTC.
Repayment, okay.
This difference, calculated on line 27, is the amount you owe back to the government. And this truly is where being proactive, reporting those income and life changes to the marketplace during the year becomes your absolute strongest financial defense.
Because if you don't report the changes,
If your income increased significantly during the year, or your family size changed and you didn't update the marketplace, your advance payments, APTC, might have continued based on outdated information, making them much higher than your actual final entitlement, PTC. That difference leads directly to this repayment situation. Understanding this Part 2 reconciliation and the potential for Part 3 repayment isn't just about filing the form correctly. It's absolutely critical for avoiding those painful, unexpected tax bills and for safeguarding your financial well-being throughout the year. It's a proactive measure to keep more of your money.
Wow. Okay, that really drives home the importance of staying on top of things. Which brings us perfectly to Part 3. Maximize your credit and avoid repayment critical scenarios and strategies. This is where we turn all that theory and calculation into direct, actionable advice, right? How do we actually ensure we get the most credit possible and, just as importantly, don't end up owing a bunch of money back?
Absolutely. This is where the rubber really meets the road for your tax savings and avoiding those nasty surprises. And the single most important rule, the absolute golden rule, if you will, is this. Report changes in circumstances promptly to the marketplace. I know we've mentioned it, but it bears repeating because it's that crucial.
Why is that the golden rule?
Because, remember, the marketplace determines your advanced premium tax credit, your APTC, based on projections of your income, your family size, who's going to be in your household for the coming year. If your actual circumstances change during the year, and let's be real, life happens, right? Income goes up or down, people move, jobs change, babies are born.
Yeah, things rarely stay exactly the same for 12 months.
Exactly. When those things change, that initial projection the marketplace used can become wildly inaccurate. This mismatch between the projected APTC and your actual final PTC leads directly to one of two outcomes. Either you miss out on credit you're actually owed during the year, or, much more commonly and painfully, you face a significant repayment demand when you file your taxes.
So it's all about making sure the marketplace has the most up-to-date, accurate information on you throughout the year, not just when you first sign up or during open enrollment. Why is this so incredibly crucial for your wallet? Like, spell it out.
Okay, let me put it this way. There's a direct quote in the official IRS instructions for Form 8962, and it couldn't be clearer. It says, adjusting your APTC when you re-enroll in coverage and during the year can help you avoid owing tax when you file your tax return.
Avoid owing tax. That's pretty direct.
It is. This isn't just a suggestion. It's your primary financial shield against unexpected tax liabilities related to healthcare credits. Think about it logically. If your income goes up significantly mid-year, but your APTC isn't adjusted down.
You're getting too much help each month.
Right. You're essentially getting an interest-free loan from the government based on your old income level, a loan that you will have to pay back in full at tax time, potentially subject to those repayment limits we'll talk about, or maybe even without limits if your income goes high enough. That difference comes back to bite you.
Okay, so reporting higher income prevents a big payback. What if income goes down?
Conversely, if your income goes down significantly, maybe you lost a job or had hours cut, and your APTC isn't adjusted up by the marketplace.
Then you're not getting enough help each month.
Exactly. You're missing out on vital financial assistance you're actually entitled to throughout the year when you might need it most to afford those premiums. Now, sure, you might get that extra credit back as a larger refund when you file your taxes months later. But in the meantime, you're struggling more than you need to with monthly cash flow. Reporting lower income gets you more help when you need it.
That makes a lot of sense. Okay, so what are some of those specific life changes that people really need to pick up the phone or go online and report to the marketplace? What triggers an update?
The list is actually quite comprehensive, precisely because so many different things can impact your eligibility for the PTC and the amount of your credit. Here are the big ones you absolutely need to report. Changes in household income. This is probably the most common and most impactful one. Whether your income goes up, new job, raise, bonus, or down, job loss, reduced hours, starting a business with lower initial income, report it. Even seemingly small changes can have a ripple effect on your eligibility percentage and your contribution amount.
Income changes, top of the list. What else?
Moving to a different address. This is important even if you stay in the same state. Your specific location, often down to the county or even zip code, can impact the cost of that benchmark SLCSP premium in your area, which directly affects your credit calculation. So, report moves promptly. Gaining or losing eligibility for other healthcare coverage. This is huge. If you get a new job that offers an affordable employer health plan, or if you lose employer coverage, maybe through COBRA ending or leaving a job, or become eligible for Medicare or Medicaid, these significantly impact your eligibility for the PTC. You need to tell the marketplace right away.
Okay, other coverage options changing is a big one too.
Definitely. Also, gaining, losing, or other changes to employment. Beyond just the income impact, changes in employment status themselves can affect your options and eligibility in various ways. Changes to your tax family composition, this covers a lot of ground. birth or adoption of a child moving out or no longer being claimable as a dependent, getting married, getting divorced, or legally separated. All of these change your tax family size and potentially your filing status, which are fundamental to the PTC calculation. Report these major life events.
Wow. Okay, that covered a lot of common life events.
It really does. The actionable advice here is simple, but incredibly powerful. As soon as any of these changes occur, don't wait. Go to healthcare.gov or your state marketplace website or call their helpline. Update your application. This simple proactive step can prevent a significant unexpected tax liability down the road or ensure you get the help you deserve. It truly is a powerful tax-saving or tax bill avoiding action.
Okay, update the marketplace. Got it. Now, speaking of other coverage, let's dig a bit deeper into minimum essential coverage, or MEC, particularly employer-sponsored plans. This seems like another area where people can get really confused about their PTC eligibility and maybe miss out or claim it when they shouldn't.
It absolutely is, and it's a common source of confusion and errors. The core rule, just to restate it, is that if you or someone in your tax family is eligible for MEC from another source, so anything other than individual market coverage you bought yourself outside the marketplace, you generally cannot take the premium tax credit for that individual for those specific months they were eligible for that other MEC.
Okay, and employer coverage is a big one here. You mentioned affordability and minimum value standards earlier. Can you unpack that a bit?
Right. With employer-sponsored coverage, it's not just about whether coverage is offered, it's about whether it meets two key IRS standards: minimum value, meaning it covers a certain percentage of healthcare costs, and affordability. Let's focus on affordability, as that's where things get nuanced. For you, the employee, your employer's coverage is generally considered affordable for PTC purposes if your required contribution for the lowest cost self-only plan that meets the minimum value standard is not more than 8.39% of your projected household income for the year. That percentage can adjust slightly each year.
8.39% of household income for self-only coverage. Okay, that's a clear benchmark for the employee.
Yes. If your share of the premium for just you is at or below that percentage, the employer coverage is deemed affordable for you and you are likely ineligible for PTC.
But I seem to recall you mentioning a significant rule change recently that specifically impacts families. This sounded like it could be a major tax-saving opportunity for many people whose family coverage through work is really expensive.
You're absolutely right to bring that up again. This is a huge and often still overlooked tax-saving opportunity, especially for families, that came into effect for tax years starting after December 31st, 2022. It addresses what was sometimes called the family glitch.
The family glitch, right. What changed?
Previously, the affordability of employer coverage for an employee's spouse or dependents was judged only based on the cost of covering the employee alone. So even if the cost to add the family was astronomical, if the self-only coverage was affordable for the employee, the whole family was usually locked out of PTC.
That seems unfair.
It was widely seen as unfair, yes. The new rule fixes this. Now, affordability for family members, spouse and dependents, is based on the employee's required contribution for covering the employee and those other family members on the employer plan.
Ah, so it looks at the cost of the family plan now, not just the employee-only plan, when determining affordability for the family members.
Exactly. This is a significant game changer.
So what's the practical implication of that new rule? How does that actually help families save money or get the credit?
The implication is potentially profound for many families. It means that even if the employer coverage is considered affordable for you as the employee, based on the self-only cost, it might not be considered affordable for your family members under this new broader calculation if the cost to cover the entire family on the employer plan exceeds that 8.39% threshold of household income.
So the employee might be ineligible for PTC, but the rest of the family could still qualify.
Precisely. If the employer's family coverage is deemed unaffordable for the family members under this new rule, then those family members might still qualify for the premium tax credit if they choose to forego the employer coverage and enroll in a suitable marketplace plan instead. This opens up eligibility for potentially millions of families who previously might have been completely shut out from receiving any financial assistance for coverage.
Wow, that's huge. How do people figure this out?
Your employer is generally required to provide details about the coverage they offer and its cost, often via Form 1095-C, employer-provided health insurance offer and coverage. Part 2 of that form usually has information about the employee's required contribution for the lowest cost plan. You'd need to compare the cost for family coverage to your household income percentage. So if you previously thought your family was out of luck because your own employer coverage was technically affordable, it is absolutely worth reevaluating your situation with this new, more favorable rule in mind. It could unlock significant savings.
Definitely a major tip there. What about government-sponsored programs like Medicaid or CHIP? How do those factor into eligibility for the PTC?
Generally, the rule is similar to employer coverage. If you're eligible for these government programs like Medicaid or the Children's Health Insurance Program, CHIP, even if you don't actually enroll in them, you're typically considered ineligible for the PTC for the months you were eligible for that government coverage.
So eligibility is the key, not necessarily enrollment.
Correct. However, there's a very important exception here that acts as a crucial safety net. If the health insurance marketplace itself determined that you were ineligible for Medicaid or CHIP when you applied for coverage, and you provided accurate information about your income and situation at that time, and based on that determination, they found you eligible for advanced premium tax credits, APTC.
So if the marketplace told you that you qualified for APTC instead of Medicaid CHIP?
Yes. If that happened, then you can still claim the PTC for those months, even if it later turns out you might have technically been eligible for Medicaid or CHIP. This prevents a really unfair catch-22 situation for individuals who relied on the marketplace's official determination and guidance.
That's a relief. Protects people who followed the rules.
It does. But again, the actionable advice ties back to our golden rule. If your eligibility for any form of MEC employer plan, Medicare, Medicaid, CHIP changes during the year, report it to the marketplace promptly. Your proactive communication is truly key to ensuring you get the right amount of credit and avoid any unexpected repayment demands later on.
It really does sound like a complex maze of rules sometimes, but hopefully with clear pathways emerging for maximizing benefits or, falling into a trap if you're not careful. What about health reimbursement arrangements, HRAs? How do those affect the PTC? I know they've become more common recently, especially for certain types of employers.
Yes, HRAs definitely add another layer of complexity to the TTC calculation, and it's essential to understand their impact because the rules are quite specific. There are primarily two types we need to consider: individual coverage HRAs, ICHRAs, and qualified small employer HRAs, QSEHRA.
Okay, let's start with ICHRAs, individual coverage HRAs.
Right. Starting back in 2020, if you or a family member were covered by an ICHRA for a particular month, you were generally not allowed a premium tax credit for any marketplace coverage you might also have had for that same month. The ICHRA takes precedence.
So if you have an ICHRA, usually no PTC. Is there any way around that?
There is one main exception. If you could have been covered by an ICHRA offered by an employer, but you specifically opted out of it, you might still be eligible for PTC for marketplace coverage. But this only applies if the ICHRA itself was considered unaffordable based on specific IRS affordability rules for ICHRAs. So if the ICHRA was affordable and you opted out anyway, you likely wouldn't get PTC. If it was unaffordable and you opted out, you might still qualify for PTC through the marketplace.
Okay, so ICHRA affordability matters if you opt out. What about the other type, QSEHRAs, qualified small employer HRAs? I know those are specifically designed for smaller businesses that don't offer group plans.
For qualified small employer HRAs or QSEHRAs, the rules are slightly different again. It also hinges on affordability. If the QSEHRA is considered affordable for a given month, based on IRS rules comparing the benefit amount to the SLCSP premium, then you're not allowed any PTC for marketplace coverage for that month. Pretty straightforward if it's affordable.
But what if the QSEHRA is unaffordable? Can you get PTC then?
Yes, potentially. If the QCHRA is deemed unaffordable for a month, you can still claim PTC for marketplace coverage. But there's a catch. You must reduce your calculated monthly PTC amount by the monthly permitted benefit amount provided by the QCHRA. Your PTC can't go below zero, but it essentially gets reduced by the QCHRA benefit you received.
So you might get a partial PTC offset by the QCHRA amount.
Exactly. It integrates the two benefits. And there's a crucial piece of actionable advice here, a small but important administrative step. If a QCHRA applies to you, make sure to write QSEHRA clearly in the top margin on page 1 of your Form 8962 when you file your tax return.
Just write QSEHRA at the top. Why?
It seems minor, but according to the IRS instructions, doing this prevents processing delays. It flags your return for the specific QSEHRA rules, ensuring it's handled correctly by the IRS systems and personnel from the start. It's a key step to avoid unnecessary back and forth or notices about potential discrepancies. Simple but effective.
Good tip. Write QSEHRA at the top if it applies. Okay. Now, let's really delve into something that causes a tremendous amount of confusion and, frankly, a lot of unexpected often very large, tax bills that absolutely shock people when they file. I'm talking about the complexities surrounding marriage and divorce when it comes to the premium tax credit. This sounds like truly a major trap for many unsuspecting taxpayers.
You're absolutely right to flag this. This area, marriage, divorce, filing status, is probably one of the biggest sources of confusion, errors, and those devastatingly large unexpected tax bills related to the PTC. It's absolutely critical to understand these rules.
So what's the main rule, the big trap?
The general rule, which acts as the trap for so many, is this. If you are married as of the end of the tax year, that's December 31st, you must file a joint return with your spouse to be eligible to take the premium tax credit.
Must file jointly.
If you choose to file as married filing separately, and you don't meet one of the very specific narrow exceptions we're about to discuss, you are simply not considered an applicable taxpayer by the IRS, and therefore you cannot take the PTC at all.
Cannot take the PTC at all if filing separately without an exception. What does that mean for any advance payments, the APTC, that might have been paid during the year?
This is where the hammer falls. If you file separately and don't meet an exception, you generally must repay all of the advance premium tax credit, APTC, that was paid during the year for any marketplace policies that covered only individuals in your tax family, you and your dependents. If the policy also covered individuals in your spouse's tax family, you generally have to repay half of the total APTC paid for that shared policy.
Repay all of it, or half. That could be thousands, even tens of thousands of dollars.
It absolutely can be, and often is. This is a primary reason people get those incredibly large, unexpected tax bills that they simply weren't prepared for and often can't easily pay. Filing separately, without understanding these consequences, is a major financial hazard zone for the PTC.
Wow. Okay, so filing separately is a huge red flag for PTC eligibility, unless you have a very specific IRS-approved reason. What are those crucial escape routes, as you called them, those exceptions that can save someone from this massive repayment?
Thankfully, there are two vital exceptions built into the law that can provide a pathway to claiming the PTC even if you are married but filing a separate return. These are really important to know about. The first is for certain married persons living apart.
Okay, living apart, what does that involve?
You might be able to file as single or more likely head of household if you have a qualifying child, and still potentially take the PTC if you meet specific IRS requirements. Generally, this involves living apart from your spouse for the entire last 6 months of the tax year, paying more than half the cost of keeping up your home, and having a qualifying child living with you for more than half the year, among other conditions. If you meet these tests to be considered unmarried for filing status purposes, you can potentially claim PTC on your separate return.
Okay, so that's one potential path if you meet those specific living apart and head of household rules. What's the second exception? You mentioned it seems to address very difficult and sensitive personal situations, providing a critical safety net.
It absolutely does, and it's a vital provision for protecting vulnerable taxpayers. The second exception is specifically for victims of domestic abuse or spousal abandonment. This is a crucial safety net written into the law.
How does that work?
If you meet very specific criteria, you can file as married filing separately and still be treated as an applicable taxpayer eligible for the PTC. The criteria are: 1. You must be living apart from your spouse at the time you file your tax return. 2. You must be unable to file a joint return because you are a victim of domestic abuse or spousal abandonment. 3. You must certify this on your tax return. We'll get to how in a sec. 4. There's generally a limit. You can typically only use this relief for up to 3 consecutive years. If you meet these conditions, this provision allows you to escape the harsh default rule and potentially claim the PTC on your separate return. It's designed to provide essential relief in incredibly challenging and often dangerous circumstances.
That's a really vital safety net indeed. How do you actually certify that you qualify for the sensitive exception when you file your taxes? Do you need to send in proof?
This is handled carefully by the IRS. You must check a specific box on Form 8962, right at the top near your name, and SSN, it's Box A on the 2023 form, to certify that you meet the requirements for this relief due to domestic abuse or spousal abandonment. Now, importantly, and this is designed to protect victims' privacy and safety, you should not attach any documentation or explanation of the abuse or abandonment to your tax return itself.
Okay, so just check the box. Don't send proof with the return.
Correct. However, it is absolutely crucial that you keep any supporting documents or records that demonstrate you meet the criteria, like restraining orders, police reports, statements from shelters or counselors, proof of separate living arrangements, evidence of inability to locate the spouse for abandonment claims safely in your own files. Keep them in case the IRS has questions later or selects your return for review. You don't send them in, but you need to have them.
Makes sense. Keep your own records. And how does the IRS define domestic abuse or spousal abandonment for this purpose?
The IRS defines domestic abuse quite broadly for this relief. It includes physical, psychological, sexual, or emotional abuse, and importantly, it also includes efforts by a spouse or former spouse to control, isolate, humiliate, and intimidate the victim, or to undermine their financial security. Spousal abandonment means you are unable to locate your spouse after making reasonable attempts, reasonable diligence, to find them.
Okay, broad definition. So if someone qualifies for one of these exceptions, either living apart head of household or the domestic abuse abandonment relief, they can file separately and take the PTC. But you mentioned they might still need to allocate policy amounts.
Yes, that's the next critical piece. If you qualify for an exception and can take the PTC while filing separately, or if you get divorced mid-year, you often run into a situation where a single marketplace policy covered individuals who are now in different tax families. This triggers the need for allocation of policy amounts, which is handled in Part 4 of Form 8962.
Part 4, allocation. Okay, when exactly is this allocation necessary, and why is getting it right so important for avoiding more tax problems?
This allocation in Part 4 is absolutely required whenever a single qualified health plan purchased through the marketplace covered at least one individual in your tax family, A and D, at least one individual who is now part of another tax family during the year. This comes up most commonly in three main situations. 1, you got divorced or legally separated during the tax year. 2, you were married at the end of the year, but filing separate returns, and you qualify for one of those exceptions we just discussed. 3, sometimes you might share custody of a dependent who is claimed by one parent but covered on the other parent's marketplace plan. Those specific rules apply there too. Getting this allocation right is crucial because it ensures that each taxpayer involved accurately accounts for their proper share of the policy's enrollment premiums, the benchmark SLCSP premium, and any advance premium tax credits, APTC, that were paid. It prevents double claiming the credit, ensures repayments are assigned correctly, and generally avoids discrepancies that could flag your return for IRS review.
Okay, so it's about dividing the pie correctly between the different tax returns involved. Can you give us an example of how this allocation works in a common scenario, like a divorce happening mid-year?
Certainly. Let's look at situation 1. Taxpayers divorced or legally separated in 2024. Let's say you and your former spouse were married and covered under the same marketplace plan for the first part of the year, say January through June, and then you divorced July 1st. For those months you are married and covered together, Jan and June, you must allocate the amounts from the Form 1095-A for those months.
How do you decide how to split it? Is it always 50-50?
You actually have flexibility here. You and your former spouse can agree on any percentage split you want, from 0% allocated to one spouse, meaning the other takes 100%, all the way up to 100% allocated to that spouse, meaning the other takes 0%, or any split in between like 70-30, 60-40, etc. This agreement should ideally be part of your divorce or separation agreement, but at minimum, you need to be consistent on your respective tax returns.
So you can agree on any percentage that's flexible.
It is. But here's the absolutely critical part. Whatever percentage you agree on, you must apply that same percentage to all three key amounts from the 1095-A for those shared months. 1, the monthly enrollment premiums, column A. 2, the monthly applicable SLCSP premium, column B. 3, the monthly advance premium tax credit, APTC, paid, column C. You can't, for instance, allocate 70% of the premiums to one person, but only 50% of the APTC. It has to be the same percentage across the board for all three items for the allocation period.
Same percentage for premiums, SLCSP, and APTC.
Got it. What if the divorcing couple just can't agree on a percentage? Good question. If you can't agree or you simply don't formally agree on an allocation percentage, then the default rule kicks in. It's a mandatory 50-50 split. Each former spouse must allocate exactly 50% of the premiums, SLCSP and APTC, from the shared policy months to their own Form 8962.
Okay, agree on a percentage and use it for all three things, or default to 50-50. Can you walk us through that hypothetical example you mentioned earlier with Keith and Stephanie divorcing? How would they handle Part 4?
Sure. Let's revisit Keith and Stephanie. They were married Jan 1, enrolled their family, themselves plus 3 kids, in a marketplace plan. They divorced July 1st. In August, the kids disenroll and get other coverage. For their 2024 returns, Keith claims 2 kids, Stephanie claims 1. They talk and agree to allocate the policy amounts 33% to Stephanie and 67% to Keith for the months they were married and covered together, January through July.
Okay, they agreed. 33% Stephanie, 67% Keith for Jan-July. How does Stephanie show this on her Form 8962?
On Stephanie's tax return, she'd fill out Form 8962. She'd go down to Part 4, Allocation of Policy Amounts. She would check the box indicating she's allocating policy amounts with another taxpayer. She'd enter Keith's Social Security number. Then there are boxes for the allocation percentages. She would enter .33 for 33% in the box for the premium percentage, .33 for the SLCSP percentage, and .33 for the APTC percentage. She'd also indicate that this allocation applies for months January through July.
Okay, Keith's SSN, .33 for all 3 percentages Jan-July, and Keith does the mirror image.
Exactly. Keith, on his Form 8962, Part 4, would enter Stephanie's SSN. He'd then enter .67 for 67% in the boxes for the premium percentage, the SLCSP percentage, and the APTC percentage. He'd also indicate this applies for January through July. By doing this consistently based on their agreement, they both avoid significant potential tax headaches and ensure the IRS can match up their returns, accurately accounting for their respective shares of the credit earned and any potential repayment owed based on their individual incomes and final tax situations.
That's incredibly helpful to see it laid out. That covers divorce. Now, what about the second main scenario? If you're still married at year-end but filing separately and you qualify for one of those exceptions, like the one for victims of domestic abuse or spousal abandonment, how does the allocation work then? Is it the same?
Good question. It's situation 2, married at year-end but filing separate returns, but only when an exception applies, like living apart head of household or the domestic abuse abandonment relief. Here, the allocation rules are actually distinct and different from the divorce scenario.
Different rules. How so?
If you meet an exception and are filing separately, the rule is that you equally allocate, meaning a mandatory 50% split of the enrollment premiums from 1095A column A and the APTC from 1095A column C for the months you were married and covered by the policy. It's not flexible like the divorce agreement. It's a fixed 50-50 split for premiums and APTC.
Okay, 50-50 mandatory split for premiums and APTC if filing separately with an exception. What about the SLCSP, the benchmark premium? Is that also split 50-50?
No, and this is a absolutely critical difference. You do not allocate the SLCSP premium from 1095A column D in this situation. Instead, each spouse filing separately who qualifies for the exception must determine and enter the applicable SLCSP premium that applies only to their specific coverage family for each month of coverage.
Wait, so I don't use the SLCSP number from the original 1095A. I have to figure out a new SLCSP amount just for my household now that I'm filing separately.
Precisely. This is crucial because when you start filing separately, your tax family size likely changes, and therefore your coverage family and the correct benchmark SLCSP premium for your specific family unit will likely be different from the SLCSP shown on the original 1095A, which was probably based on the larger combined family. You likely need to use the Marketplace's tax tool or lookup tables to find the correct SLCSP for your new, smaller coverage family for those months.
So let's take that example of Carol, who qualified for the spousal abandonment exception and is filing head of household with her son Mark while John is filing separately. How would Carol handle the allocation and SLCSP?
Right. So Carol and John were married, covered with Mark. John leaves. Carol qualifies for the exception and files head of household, claiming Mark. Her tax family size is now 2, her and Mark, not the original 3. For the months they were all covered together on the policy before separating, Carol would go to Part 4 of her Form 8962. She'd enter John's SSN. She would allocate 50% of the enrollment premiums from column A of the 1095A and 50% of the APTC from column C to herself by entering .50 in those percentage boxes.
Okay, 50% of premiums in APTC. What about SLCSP?
For the SLCSP column in Part 2, column B, Carol would not use 50% of the SLCSP from the 1095A. Instead, she would look up and enter the correct SLCSP premium amount that applied in her area for each of those months for a coverage family consisting of just herself and Mark, age-adjusted appropriately. This SLCSP for 2 people might be significantly different than the original SLCSP for 3 people. Her PTC calculation would then be based on this correct, smaller SLCSP benchmark.
And John, what happens on his return?
John, assuming he doesn't qualify for an exception himself, would also allocate 50% of the premiums and APTC to his return in Part 4. However, since he's filing separately without an exception, he's generally considered an unapplicable taxpayer. This means he cannot claim any PTC himself and would typically have to repay his allocated 50% share of the APTC, subject only to the repayment limitations based on his own separate income, which might be $0 if his income is low or capped otherwise. Unless his income is over 400% FPL, then no limit applies to his repayment.
Wow, that really highlights the importance of qualifying for that exception and checking the box.
Absolutely. For Carol, checking that box on Form 8962, Line A, certifying she qualifies for the domestic abuse or spousal abandonment exception, is absolutely vital. It's what allows her to take the PTC based on her situation and potentially avoid a massive repayment. It fundamentally changes her outcome.
Okay, that makes the allocation for married filing separately with an exception much clearer. What about the third situation you mentioned? What if no APTC was paid at all during the year for a policy that covered individuals who are now in different tax families? How do you allocate them?
Right, that's situation 3. No APTC paid for a shared policy. This might happen if the household income was initially projected to be too high to qualify for advance payments, but maybe ended up lower, or in certain complex family sharing situations. In this scenario, since no advance payments APTC were made, you only need to allocate one thing: the enrollment premiums from column A of the 1095A.
Only allocate the premiums. How are they allocated?
The enrollment premiums are allocated between the different taxpayers based on the proportion of each taxpayer's coverage family's applicable SLCSP premium compared to the total SLCSP for everyone covered. So essentially, you figure out the correct SLCSP for each resulting tax family's coverage unit, and you divide the actual premium paid proportionally based on those benchmark SLCSPs. No APTC is allocated because none was paid.
That sounds like it requires some calculation and maybe looking up those individual SLCSPs again.
It definitely does. For instance, using that example of Gary, his 2 daughters, and his brother Jim, all on one plan with no APTC, Jim is usually his own tax family. Gary, with his daughters, is another tax family. They would need to figure out the SLCSP that would have applied to Gary and his daughters, and the SLCSP that would have applied to Jim alone. They'd use the ratio of those SLCSPs to divide the total premium Gary paid from column A of the 1095A. This scenario requires careful calculation because the 1095A itself might not accurately reflect these individual hypothetical SLCSP premiums if no APTC was paid, likely requiring some extra research using the marketplace tools.
Okay. It sounds like these allocation rules in Part 4, while complex depending on the situation, are incredibly important for ensuring each person involved correctly reports their share of the premiums, the credit, and any repayment, preventing further tax complications down the line.
That's exactly right. Taking the time to understand and correctly apply these allocation rules is crucial for anyone in these shared policy situations.
And there's one more major potential tax saving strategy we should touch on, right? Specifically for people who get married during the tax year. You mentioned the alternative calculation for year of marriage in Part V of Form 8962. This sounds like it could be a real lifesaver for some newlyweds facing a big APTC repayment.
You're absolutely right to highlight this one. Part V, the alternative calculation for year of marriage, is a very specific and importantly optional calculation that can be a significant tax saver for a very particular group. Couples who tied the knot during 2024 or whatever tax year we're talking about.
Optional, okay? And how does it save taxes?
This alternative calculation method may allow these newly married taxpayers who are now filing jointly to potentially repay less excess APTC than they would owe under the general reconciliation rules we discussed earlier in Part 2 and 3. It essentially recalculates their credit eligibility for the months before they were married based on their individual circumstances then, potentially resulting in a lower overall repayment amount for the year.
That sounds really helpful. Who exactly is eligible to use this optional calculation?
The eligibility criteria are quite specific. To use the Part V alternative calculation, the couple filing jointly must meet all of these conditions. 1. They must have been unmarried on January 1st of the tax year, for example, January 1, 2024. 2. They must have been married to each other on December 31st of that same tax year, for example, December 31st, 2024. 3. They must be filing a joint tax return for that year. 4. Someone in their tax family, either spouse or a dependent, must have been enrolled in a qualified health plan through the marketplace before their first full month of marriage. 5. And crucially, advanced premium tax credits, APTC, must have been paid for that coverage during those pre-marriage months.
Okay, so unmarried Jan 1, married Dickon 31, filing jointly, had coverage before marriage, and got APTC before marriage. Got it.
If all those conditions are met, they can choose to do this alternative calculation. Why does it matter so much? Because this is a direct tax saving strategy designed specifically to reduce the amount of excess APTC repayment for those couples whose income or eligibility changed significantly upon getting married mid-year. It acknowledges that their situation was different before the wedding.
How complex is this alternative calculation?
It is definitely more complex than the standard reconciliation. It involves recalculating hypothetical credits for the pre-marriage months based on individual or different household compositions then. The instructions generally refer taxpayers to IRS Publication 974, Premium Tax Credit, PTC, for the detailed worksheets and steps involved in this alternative calculation. So it takes extra work, but just knowing this option exists and potentially consulting Pub 974 or a tax professional if you got married mid-year could potentially save you hundreds, maybe even thousands of dollars in APTC repayment. It's a targeted relief provision worth investigating if it applies to you.
Definitely sounds like a valuable option for newlyweds who got APTC before marrying. Okay, shifting gears slightly, it seems like many of these tax-saving opportunities, or the potential pitfalls, really hinge on very specific income situations relative to the federal poverty line, FPL. What about the special cases where someone's final household income actually falls below 100% of the FPL? That seems like it would automatically disqualify them from the credit entirely, right?
Generally, you're correct. The law states that to be eligible for the premium tax credit, your household income must typically be at least 100% of the federal poverty line for your family size. If your final income falls below that 100% threshold, you're usually ineligible for the PTC.
So if my income drops unexpectedly low, I lose the credit and potentially have to pay back any APTC I received. That sounds harsh.
It would be harsh, and thankfully the IRS has built in crucial exceptions to prevent exactly that scenario. These exceptions can be a real aha moment and a huge relief for some taxpayers, preventing them from facing an unexpected and often unaffordable repayment demand simply because their income ended up lower than anticipated.
Okay, what are these exceptions? When can you still get PTC even if your income is below 100% FPL?
There are two main exceptions where you can still qualify for the PTC even with income below 100% FPL. 1. Marketplace estimate exception. If, when you enrolled in coverage, the marketplace estimated that your household income for the year would be at least 100% of the FPL, and you provided information that was accurate to the best of your knowledge at that time, and based on that estimate, they granted you a PTC, then you're generally still treated as eligible for PTC for that year, even if your actual final income fell below the 100% mark.
So if the marketplace thought my income would be high enough based on what I told them, I'm protected even if it drops.
Essentially, yes. This exception prevents penalizing people who acted in good faith based on reasonable income projections that just didn't pan out due to unforeseen circumstances like job loss. It provides a vital safety net.
That's really important. What's the second exception?
2. Certain lawfully present alien exception. If you are an alien who is lawfully present in the United States, but you are ineligible for Medicaid solely due to your immigration status, for example, being within the 5-year waiting period that applies to some immigrants, then you can qualify for PTC even if your income is below 100% FPL. This exception addresses the specific gap where certain immigrants might otherwise have no affordable coverage options.
Okay, so these two exceptions provide crucial safety nets, ensuring that individuals who are genuinely in need, followed proper procedures, or face specific legal barriers aren't unfairly penalized or left without help due to income falling below that 100% FPL threshold. That prevents a very unfair potential outcome.
Exactly. They are very important provisions for equity.
Now, what about the opposite side of that coin, individuals who are not lawfully present in the United States? How do they factor into this whole PTC equation, especially if they are part of a mixed status family?
That's another important specific situation to understand. For individuals who are themselves not lawfully present in the U.S., the rule is clear. They are not eligible for the premium tax credit for their own coverage. They cannot receive financial assistance through the marketplace for themselves.
Okay, ineligible for PTC for themselves. What if APTC was mistakenly paid for them anyway during the year?
This leads to a key detail regarding repayment. The normal repayment limitations, which cap how much excess APTC you have to pay back based on your income level, and which we'll discuss in detail next, do not apply to any APTC amount that was paid for an individual who was not lawfully present.
No repayment limit. So any APTC paid for someone not lawfully present has to be repaid in full.
Correct. If APTC was paid for their portion of the premium, that specific amount must be repaid in full, without any income-based caps limiting the repayment amount. That's a significant distinction.
Wow, okay. But what about the rest of the family? If, say, lawfully present parents have a child who is also lawfully present, but maybe another relative in the household covered on the same plan is not lawfully present, can the parents still get PTC for themselves and the child?
Yes, generally. It's important to know that an individual who is not lawfully present can still be part of the tax family, and the lawfully present members of that family can still be considered applicable taxpayers and potentially take the PTC for their own coverage and the coverage of other lawfully present individuals in their tax family, like lawfully present children.
Okay, so it's not an all-or-nothing situation for the whole family's eligibility if there's a mixed immigration status. The PTC eligibility is determined individually for the lawfully present members.
Precisely. It focuses on the eligibility of each individual covered, but the repayment rules for any APTC paid for the non-lawfully present individual are strict.
Got it. That's a very important distinction. And finally, let's talk about that repayment limitation itself, which you just mentioned. This is covered in Part 3 of Form 8962, lines 27-29. This sounds like it's supposed to be a protective measure, right? A cap on how much excess APTC you might owe back if you got too much. But I think I heard you hint earlier there's a huge, potentially devastating catch with it.
You're absolutely correct on both counts. The repayment limitation is designed as a protective measure, a safety net, to prevent people, particularly those with lower or moderate incomes, from facing truly crippling repayment amounts if their circumstances changed unexpectedly. But you're also spot on, there is a very significant catch, a cliff, that can turn this protection into a major financial trap if you're not extremely careful, especially with reporting income changes.
Okay, let's break it down. How does the protection part work? How are the limits determined?
So, if you find yourself in the situation where your total APTC received, line 25, was greater than your total PTC allowed, line 24, meaning you owe money back, calculated on line 27, the IRS has specific dollar limits on how much of that excess APTC you actually have to repay. These limits are detailed in Table 5 in the Form 809-62 instructions. The specific limit that applies to you depends on two things: your final household income as a percentage of the federal poverty line, that same percentage from line 5, and your tax filing status, single versus other statuses like married filing jointly, head of household, etc.
So lower income means a lower repayment cap. Can you give us some examples of what those limits might look like for, say, the 2024 tax year?
Sure. Keep in mind these amounts can adjust slightly each year for inflation, but for 2024, the repayment limits generally look something like this. If your household income is less than 200% of the FPL, your repayment is capped at a relatively low amount, maybe around $375 if you're filing single, or $750 for all other filing statuses.
Okay, $375 or $750 max repayment if income is below 200% FPL.
If your income is 200% but less than 300% of the FPL, the cap increases, perhaps to around $950 for single filers and $1,900 for other statuses.
$950 or $1,900 max if between 200-300% FPL.
And if your income is 300% but less than 400% of the FPL, the limits go up again, maybe to around $575 for single filers and $3,150 for other statuses. These limits exist to provide a financial ceiling, ensuring that an unexpected income bump doesn't lead to an insurmountable repayment burden for those within these income brackets. You calculate the total excess APTC on line 27, look up your limit in Table 5 based on your income and filing status, enter that limit on line 28, and then your actual repayment amount on line 29 is the smaller of the total excess, line 27, or the limit, line 28.
Okay, so that sounds like a good thing, a real safety net, up to 400% FPL. But what's the catch you mentioned, the cliff? What happens if my final household income just crosses over that 400% FPL threshold, even by a little bit?
Here it is. This is the critical insight, the cliff edge. And it's arguably the single most monumental reason to be incredibly proactive in reporting any income increases to the marketplace throughout the year. If your final household income for the year is 400% of the federal poverty line or more, there is no repayment limitation, zero limit. The cap disappears entirely.
You don't limit it all. What does that mean in practice?
It means you must repay the entire amount of the excess APTC that was paid on your behalf during the year, the full amount calculated on line 27. So imagine this scenario. You projected your income would be around 390% FPL when you enrolled. Based on that, you received significant APTC throughout the year. If your income stayed there, your repayment for any excess would be capped at maybe $3,150, if not single. But then maybe you get an unexpected year-end bonus or some freelance income comes through, and it just barely pushes your final household income to 401% FPL.
Just over the line.
It's just over the line. Suddenly, that $3,150 repayment cap vanishes completely. And if the total excess APTC you received during the year was, say, $8,000 or $10,000 or even more, you are now on the hook for repaying that entire $8,000 or $10,000. The protection is gone.
Wow, that is a cliff. A small income change triggering potentially thousands more in repayment.
It is exactly the cliff effect. And it's why that simple phone call or online update to the marketplace when your income goes up isn't just, good administrative practice. It's a vital financial shield. It allows the marketplace to adjust your future APTC downwards for the rest of the year, minimizing the excess that builds up. It can literally mean the difference between owing a capped amount you might be able to manage and facing a sudden, massive, uncapped tax bill that could wreck your finances. It's a key tax-saving strategy, or rather, tax disaster-avoiding strategy, focused purely on protecting yourself from this cliff. Don't fall over the 400% FPL cliff unprepared.
That's incredibly important advice. Report those income changes. Okay, as we start to wrap up this really detailed deep dive, let's quickly go over some essential final reminders and thoughts just to make sure all this incredibly valuable information truly sticks and people know the key takeaways. First, a quick but important caution about taking other deductions and how they interact with the PTC or APTC.
Yes, this is a key caution that often gets overlooked, especially by people who itemize deductions or are self-employed. The rule is, you cannot deduct the portion of your health insurance premium that was actually paid for by the premium tax credit, either claimed at tax time or by the advanced premium tax credit paid during the year.
Okay, so no double dipping on the tax benefit.
Exactly. This is particularly important to remember if you itemize medical expenses on Schedule A of your tax return, or if you claim the self-employed health insurance deduction on the front of your Form 1040. You only get to deduct the amount of the premium that you actually paid out of your own pocket after subtracting any PTC or APTC assistance you received for that premium. It's about preventing you from getting a double tax benefit for the same expense. So make sure you adjust your deduction accordingly.
Good point. Only deduct what you actually paid. Now let's reiterate. Who must file Form 8962? This seems like a really non-negotiable rule that might surprise a lot of people, especially those who don't normally file taxes.
It absolutely is mandatory, and yes, it surprises many people. You must file Form 8962, Cranium Tax Credit, PTC, and attach it to your main tax return, your Form 1040, 1040-SR for seniors, or 1040-NR for non-residents, if any of these three situations apply to you for the tax year. 1. You are actively claiming the premium tax credit for the year on your return, i.e. you calculated a net PTC on line 26. 2. Any advance payment of the premium tax credit, APTC, was paid for coverage for you or for anyone else included in your tax family during the year, even if it was just for 1 month. 3. Or, a bit more obscurely, if APTC was paid for an individual whom you told Marketplace would be in your tax family when they enrolled, but that individual isn't actually included in any tax family on a filed tax return for that year. This requires reconciliation too.
So basically, if you're claiming the credit or if you received any advance payments, you must file Form 8962.
Correct. And here's the critical note again, the one that truly surprises many taxpayers who might have lower incomes. Even if you are not otherwise required to file a tax return, because your income is below the normal IRS filing threshold for your status, you must still file a tax return, Form 1040-101040-SR, and you must attach Form 8962 to it if APTC was paid for you or anyone in your tax family during the year.
Wow. So even if I normally don't file, getting APTC means I have to file.
Yes. You have to file specifically to reconcile those advance payments. Failing to do so when APTC was paid will almost certainly trigger a notice from the IRS demanding repayment, often of the full APTC amount, since they have no information to calculate your actual credit. It will also likely prevent you from being eligible to receive APTC in future years until you file and reconcile. It's absolutely not optional if you received APTC. Filing is mandatory in that case.
That is a crucial takeaway. Mandatory filing if you got APTC. Okay, finally, based on everything we've discussed, what are the absolute most common mistakes people make with this credit that they should really watch out for? What are the top traps to sidestep to avoid issues?
Based on what the IRS reports and what tax professionals see, there are a few critical ones that come up year after year. Let's recap the big ones. Mistake 1. Ignoring or written showing. Using incorrect Form 1095-A information. Always ensure you have the correct final Form 1095-A from the marketplace. Don't ignore it. Check the corrected or void boxes. Treat the information on it like gold, because any error there in premiums, SLCSP, or APTC reported will ripple through your entire Form 8962 calculation and likely cause errors or delays.
Okay, use the right 1095-A data. What's next?
Mistake 2. Not verifying the SLCSP premium. Pay extremely close attention to the second lowest cost silver plan, SLCSP premium, reported in column B of your 1095-A. As we discussed, this figure might be missing entirely, or it could be incorrect, especially if no APTC was paid or if your circumstances changed during a year and you didn't report them. If that SLCSP figure seems wrong or is missing, you must take the initiative to determine the correct SLCSP premium yourself using the marketplace's tax tool or resources. Using an incorrect SLCSP benchmark will absolutely lead to a miscalculated credit or repayment amount. Don't just blindly trust column B if it looks suspicious.
Double check that SLCSP number. Got it. And the third big mistake.
Mistake 3. Incorrectly. Using the annual calculation, line 10, this is a huge one. Many taxpayers incorrectly check yes on line 10 of Form 8962, thinking they can use the simpler annual calculation on line 11 because they had coverage all year. However, remember the strict rule. You must check no on line 10 and use the more detailed monthly calculation, lines 12-23, if there were any changes whatsoever in your coverage details, like who was covered, or in either the enrollment premium, column A, or the SLCSP premium, column B, amounts at any point during the year. These small monthly changes are far, far more common than people realize. Using the annual method when the monthly method was required is a guaranteed way to calculate the wrong credit amount and likely leads to those dreaded IRS notices and unexpected tax bills. When in doubt, check no and use the monthly calculation. It's almost always the safer and more accurate approach.
Okay, so use the right 1095A, verify the SLCSP, and default to the monthly calculation if anything changed at all. Being meticulous with these details sounds like the absolute best defense and the key to actually maximizing your tax savings here, or at least avoiding a nasty surprise.
That's exactly it. Being informed, being proactive about reporting changes, and being careful with the details on Form 8962 are the keys to successfully navigating the premium tax credit.
This has been incredibly insightful. It really drives home that the premium tax credit isn't just another line item on a tax form, is it? It's a truly vital, powerful tool designed to help manage healthcare costs, potentially freeing up hundreds, maybe even thousands of dollars for families and individuals. It's a genuine tax-saving strategy woven into our healthcare system.
Absolutely. But like any powerful tool, as you said, it really demands understanding and attention to use it effectively and safely. This deep dive truly underscores that knowledge is power, especially when it comes to navigating complex tax provisions and leveraging the financial benefits the government makes available. Understanding the nuances of Form 8962 and the premium tax credit can genuinely mean the difference between receiving a substantial, helpful refund and facing a large, stressful, unexpected repayment demand. It really is all about being informed and, crucially, being proactive throughout the year.
So, as you, our listener, reflect on this deep dive into the world of the premium tax credit in Form 8962, maybe consider this final thought. What other areas of your financial life might be hiding similar opportunities for significant savings, or perhaps lurking potential pitfalls, just waiting for you to apply the same level of curiosity, detailed attention, and proactive management? Where else in your finances might a little focused deep diving unlock substantial value and truly empower your financial future?